Welcome to the Value Investor TV podcast. This is a podcast that helps you grow your wealth and become financially independent. My name is Becco, and my partner,
Hari.
All right, Hari, thank you for joining. In this episode, we're going to talk about diversification. It's part 2 of portfolio management. In the previous episode, portfolio management, asset allocation, episode number 33, we talked about asset allocation. How much cash should you hold? How much stock should you own, etc. So if you haven't checked that out, please do check that out before you listen to this one. In this episode, we're going to talk about the second part of portfolio management. As we talked about in the last episode, portfolio management and value investing can largely be broken down into two different areas. One is asset allocation. The second is diversification. Asset allocation we talked about in the last episode. This episode, we're going to talk about diversification, or as we like to call it, diversification.
Yep.
So diversification in a general sense is basically saying you need to have a basket of stocks so that you don't have much volatility. You stay with the market. That's effectively what diversification is. You're hedging yourself against these extremes, extreme lows, extreme highs, effectively. And if you know what you're doing, that's a bad thing because you can only do average. But if If you like to do average, that's a great way to just hit the average. So diversification, I just wanted to kind of provide the context of what we're talking about here. And let's go into why we call it diversification.
Yeah, so let's just so you're also aware of, where all these concepts are coming from is, there's a lot of when you look at how portfolio management happens at hedge funds and at mutual funds and these big managed areas, the idea is that if I'm managing a bunch of people's money, right, what I don't want to have is a lot of volatility in my portfolio, right? Yeah. The reason for that is if my portfolio is more volatile than the overall market, what happens is my portfolio drops too much, people will withdraw my money, then I'm forced to sell more of my portfolio to pay for their withdrawals. And then eventually what happens is that money then I look bad, right? And so what you see is you see a lot of bromides that are being said by these folks around, let's use diversification to reduce our risk, right? But what you're really reducing is the volatility in your portfolio. Now, reducing your volatility also works both ways, right? You're reducing the downside volatility, but you're also reducing the upside volatility, right? And so eventually what happens is if you buy more than, say, 10 to 12 stocks, you effectively get the same rate of return as the overall market, right? You start getting closer and closer to that because any individual stock has no impact on your overall portfolio. So think about it this way. If I own 3 stocks, right, is 33% of my portfolio. If one of those stocks doubles and the others all stay the same, right, you actually get a very decent return, right? But now if you look at if I own 30 stocks and one of them doubles, then that one stock that I've picked that doubled really didn't have much impact overall on my portfolio, right? And so there's a couple of reasons that they say this, that we should diversify. And this applies to asset allocation too, right? Is you diversify into real estate, you diversify into whatever. Yep. Diversification effectively just reduces your overall rate of return to whatever the market provides. Yeah. But it also does, this concept of it no longer really matters what's in my portfolio. I can own 100 stocks. But nobody can follow 100 stocks, right? You can know a little bit about 100 stocks, but you can't know in depth what's going on with 100 companies, right? So the idea is that I don't have to spend as much time or pay as much attention to what's going on with individual companies. And that means that I can also do these kind of things where I start allocating my portfolio based on, we'll do 5% tech, 10% oil industry, and gas, all of this kind of stuff. Yeah. And then so then it becomes this diversification of industry, diversification of geography. And you can diversify into, whatever, right? Yep. But at the end of the day, if you don't know anything about that industry or you don't know anything about this whatever, it makes it very difficult for you to be able to follow that. And so people will tell you, and I see this all the time when I people will present their portfolio of 30 companies. They don't really know anything about 28 of those companies. 2 of them are fantastic ideas, and those 2 do fantastically well. And then the other 28 drag the rest of the portfolio down.
Average down.
So when you start buying too many companies, what you're effectively saying is, I don't have 30 good ideas. I have 3 really good ideas, and the rest of them are all trash.
Yeah.
And
so at that point, why would you hold the rest?
Right. And so these ideas are, and this happens at mutual funds. They do this stuff where they're required to not own more than 10% of their assets in one stock. And, there are all kinds of other restrictions. And so their volatility affects their ability to do, so they're okay with market risk, which is the entire stock market goes down, but they're not okay with individual, companies taking out a large chunk of their portfolio.
Yeah. And I just want to clarify one thing, and I want to read this quote that we have here. When we talk about the market, like the stock market, we're talking about the general basket of stocks. For example, the S&P 500 index, for example, is a good indication of how the market is doing. And so when people talk about, I just want to follow the market, that's effectively what they're saying, S&P 500 index. And when your portfolio is performing like the market, that's effectively saying your portfolio is performing just like the S&P 500 index, for example.
Right.
Okay, I want to read this quote because I think it's a good follow-up to what you talked about right there. This is a quote from the Berkshire Hathaway annual meeting in 1996. Warren Buffett said this: "We think diversification as practice makes very little sense generally for people who know what they're doing." And he follows up and says, "Diversification is a protection against ignorance," which is exactly what Hari talked about. And he says, "It is a confession that you don't really understand the businesses you own." That's exactly what Hari just said. And I think this is a core principle of value investing. You need to know what the hell you're owning in your portfolio. Yeah. And if you don't, you shouldn't own it.
Well, so I think there's, just to be as precise as possible, right? There are value investors who look purely at like PE or other things and do not allocate. They essentially just diversify, but they're only buying a basket of undervalued stocks, and those guys, beat the market, right? So I don't want to make it sound like diversification by in and of itself is the you're still, if you're buying a basket of undervalued stocks, you're still going to be on the whole doing better than the market than if you were to buy just a general basket of stocks. Mm-hmm. Now, what I would make the argument for is the older style of value investing, which is not, there's nothing wrong with it. It's actually a very valid one. Doesn't necessarily pay attention to the quality of the company, right? Mm. They are more looking at the price to book ratio, the price to earnings, the price to free cash flow, whatever other, metric you want to use. That is not necessarily wrong, right? Again, I don't have a problem with, that style of investing because it's still basing it on the value of the business. When he talks about diversification here specifically, he is saying that they are buying quality businesses that are trading at a fair price, right? That is a big distinction, right? Yep. And that's where diversification actually can, reduce your returns, right? So if I buy a company that is 70 or 80% undervalued and it's a really fantastic business, I can triple my money or quadruple my money in a 4 or 5 year period. That's a fantastic rate of return, right? But when I start then coupling that with mediocre purchases or bad, businesses, then and what I would say is great businesses tend to trade at a price premium, right? And so finding undervalued great companies is much harder than finding undervalued crappy ones, right? So you can typically find in any market undervalued businesses. Yep. What you can't find is undervalued great businesses in a bull market, right? And that's when my comment last episode was, I find I shoot for finding one stock per year. And in the last 5 years, I've found one stock per year that is worth investing, and all of them have done very well, right? And if you do that, you're finding a great business that mitigates your risk to zero, almost zero, and it's also undervalued, which is a double protection against risk. So that's what he is really referring to here with diversification.
Mm-hmm.
And when he says it's a protection against ignorance, what his caveat to that is he calls investors into two categories, right? Those are people who are know-something investors, who are do the fundamental analysis, understand the business, and so on, and then know-nothing investors. And the know-nothing, and it's not a pejorative term. He's just saying you don't want to do the work, buy an index fund.
Yep.
If you do want to do the work, then you're better off only owning a small basket of stocks. And that's Warren Buffett's philosophy. That doesn't necessarily mean that's every value investor's philosophy, but let's be honest, he's the best at it. So, we should kind of pay attention when he speaks.
Yep. Yep. And I want to point out this aspect what we talked about before we started the podcast. We talked about the volatility aspect of things, and you talked about this volatility. It doesn't really matter, because the only time the stock price matters is when you're buying it and when you're selling it. What happens in between, all this volatility doesn't really matter for us. Yep. But if you can't stomach the volatility, then you should diversify. You should try to follow the general market if the extreme volatility is too hard to stomach for you. And so I just wanted to point that out to our listeners.
Yeah, and what I would say is if you can't stomach extreme volatility, then what you're effectively saying is that your emotions are controlling your investment decision, right? And that in that case, it's index funds are the way to go.
Yeah.
Right. I mean, in the last 3 months, my portfolio dropped 30%.
Yeah, mine too.
And I'm like, whatever. This doesn't really matter. Yeah. It's dropped more than that before, and in 2009, it dropped like 60 or something percent. And I'm still way better off today than I was, if I had just sold out and bought an index fund. So, you have to really think about it from the perspective of, but what is this individual stock? Forget your portfolio. What is this individual stock valued at, and what is it trading at now? Is it very undervalued? Then eventually it will become fairly valued. And I can say in 15 plus years of doing this, I have never found that a stock that is undervalued doesn't eventually hit its fair value in the next 3 to 4 years, right? So if you are willing to hold for 3 or 4 years, you will get some fair value return out of your investment.
Yeah.
So that almost I'm not saying that it will never it'll always be the case, but that's something you should always consider is in the future things will be better, right? And at the Berkshire Hathaway meeting last year in May, Warren Buffett, before the talk started, he actually showed some slides, and he showed on December 7th or December 8th, 1941, the day that the day after Pearl Harbor was bombed, the Dow just plummeted.
Yeah.
We're going to war. Everything is looking, bleak. And he said that even if you bought,
there's a Dow,
or it may have been the S&P. No,
it was Dow.
It was the Dow.
It was Dow, yeah.
And if you bought then
like 10,000 worth of
$10,000 worth on the Dow, you would have some multi-million dollars now. So it's just this idea that compound interest is your friend. Yeah. When you buy a great business, time will be on your side, right? And so just wait for it, and it'll take care of itself.
Yeah. All right, diversification. That was that's it for us. Do you have anything to add with this one?
Not really. It's I would also say that if you're just beginning, it is hard to emotionally understand these concepts, which is why I would say write down every stock that you purchase. Write down on a piece of paper why you bought the stock and what the fair value of that stock is and what your margin of safety price is. And then whenever you feel like, it's oh, I'm panicking because it's, went down or whatever, go back and look at that piece of paper and really understand why you bought it when you were rational, right? And because you should be writing this when you're rational, not when you're, emotional.
Fearful, yeah.
And then try and reorient yourself to that concept, right? Every single time. And that I think helps a lot with the emotional part of this.
It definitely helps
problem.
me for sure. Over the last 4 months, it's been very rough, right? The whole market was rough, but the portfolio was rough as well. So going back to the conference calls, going back to the fundamentals, going back to what I thought about earlier, really helped me focus on what is important here, what is the true facts. And so that really definitely helps. So that's it from us. Diversification, part 2 of portfolio management. We talked about allocation in the previous episode. This episode is all about diversification or diversification. All right, that's it for us in this episode. We'll see you on the next episode 35.
All right.
Thank
Thanks.
you.